Hi everyone, and welcome back to the Independent Dollar as we make our way through our February tax tips and updates series. If you're joining us for the first time, we make new videos each week on personal finance topics in a way that's straightforward and easy to understand. Today's video is all about some of the important 2020 tax updates that you need to know if you live in Canada. Now, some of these are new for this year, and some of these have been around for a few years, but you might not be aware of them. Either way, the penalties can be pretty stiff, so let's take a closer look. First up is Bitcoin mining. Were you busy mining Bitcoins last year? Well, CRA now considers Bitcoin mining as employment, and the Bitcoins you receive for mining as income. Whatever the value was of the Bitcoin at the time you first received it is the amount you need to claim on your tax return as income. If afterwards you decide to sell them, then you'll also be required to record either a capital gain or a loss. Now, in some cases, income from Bitcoins could be considered business income, so how you report the income, the gain, or the loss could be different. I'll include a link to the CRA page specific to this if you're interested in learning more. The second tax tip that you might not be aware of is foreign property. Do you have a bank account outside of Canada? Do you work for a US-based company that issues stock as part of your compensation? Or do you currently own stock from a foreign corporation? If so, you're required to disclose foreign property on your taxes if you paid $100,000 or more for it. When we think of property, a lot of us think primarily of real estate. However, property includes so much more and can be as simple as a bank account balance in the United States. So a great example could be a checking account you have in Florida with $100,000 or more in it. Or another example is stock. Let's say that you purchased $100,000 of a US-based company's stock. Maybe you bought it all last year, or maybe you've been buying it slowly over the past few years. But as of last year, the total cost to you is now $100,000 or more. Well, according to CRA, you must disclose that you own those stocks on your taxes, even if the fair market value fell below $100,000. This would also include company stock that was paid out to you as a bonus or part of your annual compensation. In order to disclose this, you'll submit T1135 with your taxes, and I'll include a link to this form in the description. This is really serious, and failing to do this will result in a fine of $500 per month, up to $12,000, plus additional penalties based on how long it takes you to eventually disclose that information. Now, there are exceptions to this rule. If it's personal use property, like a cottage that you don't rent out in another country, then you don't have to disclose it. Or if you're holding stock within an RSP or a tax-free savings account. But US listed stock in a non-registered account would fall under the reporting requirements. Next up, and maybe the most crucial, is your principal residence. If you watch my video on how to avoid a tax nightmare, then some of this isn't new to you. Essentially, if you sell your principal residence, you must disclose that when you file your taxes. If you don't, there are some pretty heavy penalties. Initially, CRA provided us with a bit of flexibility to make a voluntary disclosure if we missed declaring the sale on our taxes, and that was back when the new rules came into effect, which was 2016. My guess would be because they're acknowledging that there would be a period of time required for taxpayers to learn and implement the new requirements either on their current returns or make adjustments on previously filed returns. However, this year that's changed. Failure to disclose the sale of your primary residence on any return between 2016 and future years will now involve a minimum penalty of $100 a month up to $8,000. What's worse, they're within their rights to retract the principal residence exemption on that property, meaning, in addition to that penalty, you will now be required to pay capital gains tax on any money you made on your home. Our fourth tip is personal use property. You know how you can claim a capital loss against your capital gains? Well, the same is not true for personal use property. An example of personal use property could be your cottage. If the value of your cottage increases over time, you're going to have to pay capital gains tax when you sell it. However, if the value of it goes down, you can't claim the capital loss against your capital gains. Now, an exception to this would be if you were renting the cottage. In that case, it would then no longer be considered personal use, and you could therefore claim a capital loss. Otherwise, unfortunately, you're out of luck. Now let's take a closer look at prescriptions and medical marijuana. Generally, prescriptions can be claimed on your tax return for any amount not covered by your insurance. However, did you know that if you received a prescription for a drug that is available over the counter, it can't be claimed on your taxes? Even if it's a legitimate prescription from your licensed doctor, you cannot claim any portion of that on your tax return. Even if you have a prescription to purchase medical marijuana, recreational cannabis cannot be claimed, nor can cannabis accessories regardless of where they're purchased from. You must be purchasing medical cannabis directly from a company that is licensed to sell medical marijuana, according to the Cannabis Act. I'll include a link in the description to a current list from the CRA site. It'll show you which companies are currently licensed or not licensed to sell medical cannabis in Canada. Last but not least is attribution rules. Are you married with a spouse that earns less than you? Have you ever thought about transferring income to your spouse to lower your taxes? If you have, you're not alone. CRA's thought of that too, and that's why they implemented attribution rules. To quickly summarize how they work, if you loan or gift money to your spouse or to a family member who's under the age of 18, like your children or your grandkids, any income made will be attributed back to you. So let's say, for example, you deposit $50,000 into a joint bank account with your spouse. They then invest that money in their name only and earn $5,000. That $5,000 needs to be claimed by you as income on your tax return. It cannot be claimed by your spouse. And the same would be true with a joint investment account. Even though both of your names are on it, you cannot decide who is going to claim the income. The income must be claimed by the person from which the money originated from. Therefore, if you each put $10,000 in, then you would split the income 50-50. But if all of it came from one spouse, then that is the only person to claim any income earned. This wraps up our latest video in our February tax tips and updates series. Stay tuned for our next video where we're going to break down the withdrawals from RESP accounts. Thank you so much for watching, and we'll see you back here on Thursday.